Yo guys, it's John here with Option Lab. In this video, we're going to be discussing the bull put credit spread, how to enter the trade, when is the best time to enter the trade, and most importantly, how to make money with these trades in 2025. I'm going to make it super beginner friendly and break down each step one by one. And by the end of the video, I promise you will feel confident entering the bull put credit spread. So normally I'm on camera, but for this video, I needed my pen, so I'm off camera for this video. Anyway, let's first start with when is the best time to enter a bull put credit spread. So if you look here, this chart from Tasty Bites is very helpful. So when we look at spreads, right, in this case, we're looking at vertical spreads. The best time to enter the bull put spread is when IV rank is high and we're bullish on the position. Remember, bull put spread, I know that sounds like an oxymoron, but it's a credit spread. So when we talk about IV rank, I'm looking here at 50 plus if you're setting up a scanner to look for these positions. IV rank high and bullish, we have a bull put credit spread or a put credit spread. And in this case, let's discuss why that is. So when IV is high, option premium is higher, and since we're a net seller, we want IV and option premium to be higher because we're receiving a credit. So that's the general idea of why we want to enter a bull put spread when we're bullish and IV rank is high. So this just kind of like goes through, you guys can read it, but I'm going to be talking about kind of like how to calculate max loss, max profit, etc. You can see here we use two put options to form a range consisting of a high and low strike price, which I'm going to run through in here. By the way, if you guys want all of my course videos for free, click the link in the description in Discord, message me course on Discord, and I'm sending you guys, I have about 30 plus videos explaining all of the different option premium selling strategies I use. And as you can see here in my Discord, a bunch of you guys have been finding value. So let's get back into the video. Let's discuss an actual example of what I'm talking about. So this is our stock here, and it's moving as so. And the first question when we ask, when we enter a bull put credit spread is, what price do we think the stock is going to stay above by a certain expiration? In this case, our stock is trading at 120, and what I've drawn out here is that we believe the stock is going to stay above 115. I like to call this setting the floor because basically you're creating a floor that you think the stock is going to stay above by expiration. In this case, we have 115, and for selling to open the 115 put option, we receive a $120 credit. That means that money is handed over to you. Then, as a protective layer of the option of the spread, we buy, in this case, a strike price below the 114 put option. And for doing so, since we're buying the option, we're paying out an $80 debit. So if we received 120 and we paid 80, that means we collected a net credit of $40. And as you can see here, the max gain is the net credit received. It's taking the credit we received from the selling of the put option and subtracting off the debit that we paid for the put option. So let's calculate the max loss. The max loss is calculated by taking the width of the two strikes, in this case, 114 and 115. So that's a $1 width minus the credit received. So if we imagine this as $100 in total as the width, we have a $40 credit that we received, and then a max loss of 100 minus 40, which is 60. And the criteria for profit here is that the stock stays above our selling leg by expiration, in this case, 115. And we would receive that as our max profit and that as our max loss. Okay. So let's go through an actual example of one of the trades a while back here that I alerted in Option Lab and kind of discuss how this works in real time. So as you can see here, you can see kind of like my alert structure. We're selling the higher strike and then we're buying the lower put. But let's look at what kind of like someone would say when they're entering this trade. So here's our trader. He says, I think Apple will stay above 115 by July 31st. So he's setting his price floor that he thinks it's going to stay above and the expiration date, which he thinks it will stay above by. So in that case, what would we enter? We'd enter the Apple, that's just the expiration, the 115-114 bull put spread. 115 is our price floor that we think it's going to stay above, and then we buy the put option below that to create a bull put spread. For opening that trade, we would receive a net credit of $40, and then when we calculate our max loss, it will be 1, which is the width of the strike, minus the credit received for a $60 max loss. Okay, so let's just kind of summarize what I'm talking about here in a few steps. So the first thing we want to do is we want to set a price floor. The price you think the stock will stay above by expiration, and this is the put you will sell. Keep in mind, we're entering this as one trade, right? Next, we're going to buy a put with a strike price lower than your price floor, in this case, 114. We're going to calculate the risk reward using this formula right here. And let's finish off here by talking about what are some scenarios at expiration. So at expiration, either A, the stock will stay above your price floor or the option that you're selling. If that occurs, both puts are going to expire worthless, and you're going to collect that max gain of $40, which is the credit you received for entering the trade. The second scenario is the stock ends below both strikes so that both expire in the money and you would take the max loss. So in this case, if the stock ended all the way down here at 110 at expiration, we'd have a max loss of $60. Now, if you're trading a smaller account, this gives you a lot of leverage because you can trade any price stocks and create spreads that allow you to decrease the necessary buying power for taking the trade and create a max gain, max loss scenario. And there is obviously a situation where we would have the stock end between our strikes, which I go into more depth in my course. If you guys want it for free, DM me course on Discord and I'll send it to you guys. Anyway, I really hope this was helpful. This is an introductory video into the bull put credit spread. And if you liked the video, stick around for the bear call credit spread. Comment down below what you think. If you have any questions, leave a like and subscribe. I'll see you guys in the next one. Peace.